Hey YouTube, it's Matthew Decker, Leverage Wealth Management and Cash Value Life Insurance Reviews. I'm back again with Brady Watkins, my associate here, and we're doing another policy review for you today. If you saw the video that we did a couple weeks ago, or maybe a week ago at this point, we talked about Penn Mutual and their index life policy. We're actually sticking with Penn Mutual today, but Brady, we got a little bit different flavor.
Yep.
What are we talking about today?
It is a different flavor. A lot of big players in the cash value life insurance space use this very product. So we're reviewing the guaranteed whole life product on Penn Mutual. So again, tell us your thoughts on Penn Mutual just as a carrier, just for starters.
Yep. So we talked last time a little bit about Penn Mutual. Great company, mutually owned, which means the policyholders are the owners of the company, which is a cool story to be able to tell. That doesn't necessarily mean that you have the best product, but it's a cool story to be able to tell. Very highly rated. They've been in business forever. I would have no problems doing business with Penn Mutual as a company. They've got a great reputation. And if I was in the market for whole life, I think this is probably the policy that I would look at first.
Great. Well, that's good news because we are looking at it. So obviously, whole life products don't earn interest the same way that IULs do. So tell us a little bit about whole life dividends and how it's kind of playing out here on this product.
Yeah. So the whole life space is totally different than the index life space, as I'm sure most of you know. And the biggest questions revolve around two main things, which I'm sure we'll probably hit on both of them today, but we're talking about dividends now. So let's talk about the idea of dividends. Every single whole life company is going to quote you some kind of dividend rate. Now, that's fine, but oftentimes I feel like quoting the dividend rate is only half of the story. And so you'll see something like maybe this dividend rate is paying 6%. All right, it's a 6% dividend. I don't actually know what this policy is today from a dividend rate. It doesn't really matter. But if you've been positioned a whole life insurance policy, I know you've been told about the dividend rate. The first thing to know about dividends, they're not guaranteed, which is why there's two columns here. You have a non-guaranteed column and you have a guaranteed column. The non-guaranteed column shows the current dividend as it is today. And you'll notice that the cash value, I mean, we're just looking here 20 years down the road, let's say your cash value is $490,000 at the current dividend rate. If you look at the guaranteed dividend rate, you're at $347,000. So that tells you right there, just because it says dividend doesn't mean it's guaranteed. It's not guaranteed. But what is a dividend? It's hard to say because they tell us what the dividend is, but they don't necessarily tell us where the fees are, and they don't necessarily quote us an actual rate. And so it's weird for me to look at a whole life insurance policy and talk about dividends, but I'll tell you how I think about it. So the first thing I do is I get out my calculator, because what I really want to figure out is what's the actual rate of return on this policy. And so since this is a life insurance policy, and I know that in general, most of the fees are going to be in the early years. Now, the whole life people will tell you that the fees are level forever, but they can't prove that because there's no fee ledger. I know that most companies charge the majority of the fees in the early years. And if you say, how do you know that? Well, there's a $0 dividend for the first 3 years. So that tells me something's going on here. But let's get out of the premium paying years. We're paying premiums for 10 years. So let's just go out to year 20. When I want to find the rate of return on a whole life insurance policy, here's what I'm going to do. I'm going to take the cash value in 1 year and I'm going to divide it by the cash value in the previous year. So if we do 514 divided by 490, that is 1.0489. All right, so let's just call that a 5% internal rate of return once we get 20 years down the road. So if you've been quoted a dividend rate, this is what I would encourage you to do. Take your ledger, like I just did, go out until you're done paying premiums. So this is paying premiums for 10 years. We go well past that, maybe 20, 25 years down the road, and you're going to take one cash value year. I'm taking year 21, and you're going to divide it by the previous year's cash value, assuming no premiums have been paid, $490, and you're going to get your actual rate of return, which is way more accurate, you'll see, than the quoted dividend rate. So that's a long-winded answer on dividends. It's hard to give you a real answer because they don't give us any information. But if If I'm looking at a product, this is the process that I'm going through to determine what kind of rate I might be getting. Hopefully that's helpful.
It is. Yeah. And you touched on fees, and I want to talk about that a little more. We get a few questions during the discovery calls on, hey, they're throwing at us, hey, IUL is more expensive than whole life.
Hear it all the time.
Yep. So what do you think about that? How do we see that? How do we see the fees on these products?
Man, I'd say show me the money. I'd say prove it. Prove to me that it's more expensive, because you can't prove to me that it's more expensive, because as I pour through this whole ledger here, there absolutely is no fee ledger. So it's easy to say, hey, I heard index life is more expensive than whole life. Well, you may have heard that, but you've never been proven that, because you can't be proven that, because the fees are kept in a black box. And the only person with the key is the actuarial team who built the product for the company. And so I have never seen a fee ledger from whole life. I can guess, I can probably get pretty close. And if I wanted to get close, I would look at the difference between the stated dividend rate and the actual rate of return that we just kind of did in that last little exercise. And that might get you close to the yearly fee mark. The difference in the growth at 6% versus what you actually received is probably something close to the fees that you paid in that one given year. But again, we don't know what they are because they won't tell us.
Right. And I think that's something to note at the very least, especially if you're the type to want to know all the answers. There is at least something that you just can't know.
It's a black box.
So, moving on, we talked a little bit about just kind of general whole life type of conversations, but I want to talk about Penn Mutual's loan provision. We get a lot of people wanting to do loan out methods, whether that's infinite banking or real estate transactions through life insurance. And people are pitching the Penn Mutual Whole Life for this type of scenario using loans. So what are your thoughts? And let's go through that.
My number one thought when it comes to loans, and this applies no matter what policy you're looking at, if your loan rate is higher than the amount of money or interest you can earn on the contract, then what that means is anytime you take a loan, you're basically upside down. You're being charged more for the loan than what the loan is earning you. So that's the first thought that I have in my mind. I got to see, okay, what type of policy do we have here? Do we have a policy where we can out earn the loan rate or not? And fortunately, we actually already did a decent amount of the math to figure out the answer to that question. We divided that cash value out in 20 years down the road, giving this policy the benefit of the doubt, letting it grow for a long period of time before we do the measurement. And we came out with 1.0489. So let's just call it 5%. Now that's basically the rate of return on the policy once you get out past all the premium paying years. Okay, so the question I have is, can we out earn 5%? And the answer is no. We just did the math and we were at 4.89%, which is not 5%. We're rounding up to help Penn Mutual out, but it's not getting there. And how do I know it's not getting there? Because when we read the policy loan language, two things. Number one, I see 5%. So I know that we are underperforming the 5% loan rate by a couple basis points, 10 to 12 basis points. But then I notice another thing. I noticed the verbiage that they use here.
Yep.
Did you notice the verbiage, Brady?
Yeah, I see one word that makes me see that there's more here than meets the eye, and that word is current.
That is the same word that
current
I
loan
also
interest rate
had highlighted here. Current loan interest rate. So what does that mean?
To me, that means that this is not fixed at 5%. Simple as that.
That's how I read that as well. The current loan interest rate is 5%. So what we have here is a situation where the current dividend scale is underperforming the current loan rate. Am I missing that?
That's what I got too.
That's what you got too. Okay. Which would tell me that if you're using this policy to generate income, I don't see how it's a good income vehicle, because you're going to access your income via loan. The other option is to withdraw money, withdraw to basis, but eventually you're going to have to start loaning dollars out if you don't want to be taxed on it. And if you don't want to be taxed on this money, it means at some point you're going to be underperforming your loan rate. That's how I read it. Is that how you read it?
That's how I read it.
Okay. Which is why we traditionally prefer index life for cash building and income generating policies, simply because you do have an opportunity to outperform your loan rate. Here, we don't have it. I wish that we did, because it would be a less risky way to get some arbitrage on our loan value. And if we had that option, I'd probably be all over this type of policy. But since we don't have that as an option, I don't see how I can really get behind it with my full weight from an income standpoint. And just to kind of provide a little bit more context, this policy that we're looking at here, I think is a couple years old. And we have the updated version of this exact policy. It's the 2 version. The one we looked at was the 1 version.
New
this
product.
Is 2.0. Yeah, 2.0. And so 2.0, Penn Life 2.0, the current loan interest rate is quite a bit higher. It is 5.7. So that just shows you right there, that word current is there for a reason.
Yep.
It changes over time. It's now 5.7. And we're nowhere near a 5.7% internal rate of return on this policy's cash value, which means the spread between what you earn and what they charge you is widening, not in your favor.
Right. So what does a rising loan rate do to this type of product?
In a perfect world, the credit or your internal rate of return rises with it. But it doesn't have to. But in a rising interest rate environment, you will absolutely see your loan rate continue to rise.
And that's why it's important to look at all the variables inside of this policy and this product.
It's also why we prefer a fixed loan rate.
Exactly.
Because in a rising interest rate environment with a fixed loan rate, it stays the same,
Yep.
which is a good place to be.
You're essentially eliminating a variable in your contract.
That's exactly right.
So what would be a good use for this product? I think you already kind of touched on this isn't a good income vehicle, but what would this product be good for in terms of using it?
Yeah, I've kind of changed my tune in recent months and weeks on whole life insurance. I mean, we just looked at how this is essentially a little under 5%, what would we say, 1.489, which is a great rate of return in a vehicle that can't go backwards and provides some guarantees. I think the guarantee on this is maybe 90 basis points, 0.9%, somewhere in there. I didn't do the math on it, but that's typically what it is. If it's 1%, great. If it's 1.2, great. It's somewhere in that range. But as a relatively, it's not risk-free, but as a interest rate-driven product, getting 4.8% tax-free is pretty good if you're not willing to take hardly any risk at all. So if that's you, if you're not looking to take hardly any risk and you want a fixed product that's interest rate sensitive and you're looking for some tax advantages, Whole Life can absolutely be the place to build up a nest egg that can be accessed later. Just know that if you do intend to use it as an income stream, building up wealth is one thing, but then how you access that wealth is kind of a different set of calculations. And in this particular product, how you access the dollars is not as advantageous as maybe we would want it to be.
So I think the point is, different products do different things.
That's right.
It's really a matter of what you're hoping to do with it.
That's right. That's exactly right. Yeah. So if you're looking at a whole life insurance policy and you want to know, hey, is this thing even for me? Is it going to accomplish my goals? Am I getting a good deal? You should reach out to us. We do 700 some policy reviews every single year. You've heard us tell you before that we've saved $60 million in lifetime fees by doing policy reviews and getting people into better structures. We've increased lifetime income on these policies of the people who choose to do business with us by about $80 million. And that number just keeps ticking up every day because, again, we're doing 700 reviews a year. You should absolutely reach out to us. I promise you that you're going to be in great hands. We really focus on educating you to a point of making a decision that you feel comfortable with. We're not just trying to sell a product. We want you to accomplish your goals, and we want you to do that as safely as possible with as much knowledge as possible and feel great about it along the way. So we'll put a little call-out card above if you'd like to book some time with us to just chat about your goals, maybe send us a policy to review. We'd love to facilitate that process with you, and I think that you'll be happy if you do. So leveragewm.com/contact-us, or you can click the link above or below in the description. And until then, take care, but we look forward to talking with you soon.